guess what? You got to qualify. A reverse mortgage 15 years ago, you would take a mirror and you would fog a mirror and qualify because they had so much equity, they didn't care about your monthly income. But now you do have to qualify. It's not a robust or rigorous, a really intense qualification like a traditional loan, but they just want to make sure that you have enough money coming in to pay all the bills going out. Usually, in about 9 out of 10 times, Social Security income is all I need. Many times, most of the time, I never need tax returns or banking statements at all because the Social Security is enough to pay all of the expenses on the property. Plus, the unused equity in the home, I repeat, the unused equity is an asset that can be depleted and converted into monthly qualifying income. It, my friends, is a winner. It makes reverses a lot easier to qualify for. So many of my clients call me, they go, hey, I tried to get a home equity line from Bank of America, Chase Bank, Wells Fargo, a credit union. They can't qualify many of the times because they won't qualify like a reverse mortgage because we use the unused equity as income. And all we need is Social Security income and a decent credit report. Not perfect, not sterling, not gorgeous, but a good, solid credit report. That's what we need. The taxes, the insurance, the HOA, guess what? It's the same as a regular loan. You have to pay it. No big deal. Of course you have to pay it, but I need to say that. Everything's the same. The only difference is, see the repayment, number 3, is you don't have to grab your checking account, your checkbook, your Zelle, your Venmo, and make a payment. You don't make a payment to the lender if you don't want to. Instead, you just allow the interest to accrue, to get tacked on, to be added to the loan amount. That's it. So the loan amount grows over time, but guess what? Your savings account grows over time because you're not using your savings account. You are instead just adding it to the loan amount, which reduces the future equity that perhaps your kids, your heirs might not get. But guess what they will get? The extra money in your savings account. The I word. The I word, it's not inflation, it's interest. Every lender in America, every bank, they make loans. You know what they do? They charge closing costs and they charge interest. That's it. There's no free lunch. All this is, and a great analogy is this, it's like going to the restaurant on a 5-course meal. And instead of paying for each course 5 different times, with your credit card, what they say is, at the end of your beautiful night here in the restaurant, we're going to charge you, okay? The difference is, of course, instead of the end of the night, it's the end of your life. Both people on title, once they're gone, the check has to be paid. And what happens is the kids, the heirs, get in there and sell it for as high as they can, and they pay off the reverse mortgage. And the difference, the gap, the difference goes to the heirs, to the kids, and or to the charity or whoever the heck is listed in the living trust or the will. Here's the big differences. On a reverse mortgage, the difference is there's an age requirement and there's an equity requirement. You gotta be age 55 or more. You just have to be, or else it's not gonna work. One of the 2 borrowers has to be at least age 55. The equity has to be there. You got to have lots of equity, at least 50% many times, sometimes 60%, sometimes 40%. You got to have a lot of equity. This is not a no down loan. This is not a VA loan. This is a loan that requires a minimum age of 55 for a conventional reverse mortgage, age 62 for a government reverse mortgage. You got to have lots of equity. Occupancy is key. Your head has to sleep on a pillow. You gotta live in the home. You gotta live in the home. But sometimes, due to health issues, you can leave the home for up to a year and still come back. Call me on that for details. So it's not like you have to be there 365 nights per year. There are exceptions, but the intent is it's your primary owner-occupied home. This is not for investors or for, real estate people trying to get in on a non-owner occupied rate rental. The payments is the big one, as mentioned earlier. The payments are optional. 98 out of 100 people that I deal with, 98 out of 100 decide, you know what, I'm going to defer the payment, pay it later when I'm not here on earth, or when I sell the home, I'll pay it later. There is a, and this will tell you, I'm age 64, kind of like, I think Paul McCartney sang a song about me, about being age 64. But this is how old I am. There was a TV commercial called Fram oil filters, and they were a little high priced, but they did a great job on the oil filter. And the guy would literally get on the TV and say, well, I realize it's a little bit more to get this Fram oil filter, but you can either pay me now or pay me later. A reverse mortgage is the same thing. You can pay me now or pay me later. A reverse mortgage allows a senior to live in their home in comfort and pay later, not now, not each month. Why